Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host for the day, Paul Curcio, managing editor of ETF.com. Sumit Roy, your regular host, will return next week. In today's episode, we'll take a closer look at some of our most popular and interesting stories of the past week. Joining me today are senior content editor Ken Tooney and contributing editor Ron Day. Good morning, guys.
Hey, Paul.
Glad to be here.
Happy to have you. All right, well, let's get this thing started. Ron, you wrote an interesting story this week on share class reviews at the SEC. Now, this is not a sexy story by any stretch, but does it
Yeah,
have
scintillating name.
You're right. It's yeah, but it's a good read. It's for
Yeah.
anybody who has not caught it yet. Please look it up on our site. But it does have ramifications for ETF investors and issuers. So, can you explain the regulatory hurdles that have to be gone through for the average reader?
Yeah, well, just to kind of set the stage a little bit, this whole issue goes back to like 2000 when Vanguard was granted this patent that permitted it to create this ETF share class. Basically, they took their mutual funds and the investment strategies from their mutual funds, and they got permission to create ETFs. Exclusive patent until 2023, and then as this ETF firms, I guess, have been pitching for years to get this to be in on it. The applications, as it was expiring, the applications started piling up. Since the patent has expired, there's been 51 applications. So now, this week, acting chairman Uyeda is pushing to get these applications processed. He didn't say approved, but he's looking for like an expedited process to kind of get this whole thing going, get more ETFs on the market. And obviously, there are firms like BlackRock, Morgan Stanley, Dimensional, FM Investments. They want to start creating ETFs out of their mutual funds.
So they
Why?
don't have any. They don't have this yet. Only Vanguard does?
No, right, only Vanguard. And I don't know if Vanguard has been using it in the past few years. They used it to create their first ETFs. And I don't know who the genius was over there who kind of got this exclusive patent, but it's helped them for, 20 something years.
Does that give them
So
any kind of an edge over the other competitors, the other issuers like BlackRock and State Street, et cetera?
yeah, it does. I think the whole process of creating the ETF is simplified with this. They could do it. They could do it faster if they've got an idea that is working really well, and they can mimic that or mirror it. And it's just a whole easier way of doing things. What's working? Let's create one out of this. You
So
know.
what does this
So
mean for the average ETF investor once these applications start getting reviewed and let's say
some of this stuff is kind of behind the
accepted?
scenes, for your average ETF investor. I don't know if at the margins, there's kind of like a cost thing that might be kind of rolled into this. Maybe you could argue that it would just create more opportunities, more varieties of funds. But again, this is kind of insider stuff. This is for the industry participants who have been watching this and hoping to kind of get the advantage that Vanguard has enjoyed for so long. And again, where's all the action going right now, or has been for the past 10 years? It's not been in mutual funds, it's been in ETFs. They're growing, mutual funds are shrinking.
It is definitely a trend, and this is definitely certainly a part of it. And I love looking at how the sausage is made. So it's a great story and really insightful that you picked up on it. Thanks, Ron. Now, Kent, you did something a little different. Instead of digging around and looking at what's happening in the industry, you got out your crystal ball and had a Nostradamus moment this past week with your 10 ETFs for the next 10 years. Can you tell us a little bit about the methodology that led you to your picks?
All right, glad to. Yeah, I would say it was half Nostradamus. There's, of course, there's no guarantee that the past repeats, but it generally rhymes, to paraphrase Mark Twain, I believe he said that. But anyway, about half of the 10 funds, about five of them are, what has performed best over time. in the past. So historical returns. Number one, well, not in any particular order, but S&P 500 index ETFs, like VOO, Vanguard S&P 500 ETF, which, by the way, we covered, is now, again, for the second time, the largest ETF in the world, and for a good reason. Because most professional money managers do not outperform the S&P 500. In fact, about 2/3 of them don't. And so if you can't beat them, join them then. So that's the idea of holding an ETF like VOO over the long term, because you're probably going to do better than most professional money managers do. Along the same lines, say a total stock market index ETF, Vanguard has the largest one there as well, VTI. The Invesco QQ Trust, QQQ, tilted towards technology, or its lower expense fund, QQQM, has outperformed over the past. So we're going to, if we're thinking technology is going to be around, which I'm sure it will, that'll outperform. And then some of the other classics that lean more towards, income, dividends from income from dividends, like SCHD is in there. That's a Schwab US dividend equity ETF. And then as far as future goes, well, this is kind of part history and future, is the VanEck Semiconductor ETF, SMH. Semiconductors are the best performers in terms of sector over the last 10 years, and it's likely to do that in the future because they drive artificial intelligence, which is maybe the brightest technology in terms of what we can see now over the next 10 years. And then some of the other themes like biotechnology, artificial intelligence can help drive that and help come up with cures for cancer faster and everything. As far as countries, India looks like it probably will be the best performing country because it's young population and expanding middle class. And then some of the outliers like quantum computing, that's exponentially faster than even artificial intelligence computations. So QTUM there, and then nuclear energy is clean and low cost. So that's the Range Nuclear Renaissance ETF, NUKZ, and then blockchain, which that's part of the future. There is everything from the way we trade, investments, finance. So blockchain technology, if you want to cover that, is a good ETF, is Global X Blockchain ETF, BKCH. So yeah, all over the place. I welcome anyone that wants to come up with some of their best 10 over the next 10 years, but I wouldn't be surprised if at least 8 of those are some of the better performers.
Well, Kent, aside from being a content creator extraordinaire for us and researcher, you're also a practicing certified financial planner. Do you recommend any of these to your clients for their portfolios? And if so, what's been their response?
Good question. Yes, I use S&P 500 index funds as core holdings. And what that means is that's where the bulk of the portfolio is held, say 30, 40, or even 50%, and then build around that with what are called satellites. So a core and satellite structure. So yes, now the clients who don't mind taking on more risk, SMH is an example of a fund that I use in client portfolios, a semiconductor ETF. Or even if I talk about one of my favorite stories or favorite clients is not really a client, my 2 sons that are in their 20s. So they're QQQM, which is the lower cost technology. So we just dump it all in there and they're good to go. So yes, I do eat my own cooking, so to speak.
In the spirit of full disclosure, which of those do you hold in your own personal portfolio?
I have to go back to the article and look, but
it's at the bottom of the article. We'll say that for everybody who's here. Yes, Kent does hold some of these, and it's in the article.
Right. Well, QTUM is one that comes off the top of my head, and Nukes, those 2, and UKZ.
All right. Great story, Kent. And it's really popular. It's really taken off. A lot of people are reading it and sharing it online and in social media. So if anyone's listening, if you haven't looked it up, we've got it. So Ron, let's shift gears a little bit. Looks like you've settled a very long-standing question in the world on everyone's mind. In your story recently this week, you declared that size does matter, at least when it comes to ETF investing. Could you elaborate on that a little for us, please?
I had no idea that it was such a long-standing question outside of the exchange traded fund industry. I've got to read up on this stuff. But regarding ETFs, and this is a good segue from what Kent was talking about. We were talking about value creators and destroyers. Morningstar put out a survey the other day. Of course, they put on a provocative headline, which really was, kind of grabbed us. Who were the biggest value destroyers? Who are the biggest value creators over the past 10 years? Mostly focusing on ETFs in this survey. They did a little bit of mutual fund stuff, but just kept the segue is that QQQ over the past 10 years was it was like the number three value creators. So, but back to the size matters thing is what we were kind of, let us in here. And what Morningstar's point was is that the biggest ETFs, the biggest issuers are the biggest value creators. And what they said is there's an advantage to being a gargantuan fund. You get a positive feedback loop. Size and performance, strong performance attracts more assets, which means the biggest fund shops have the most impact on wealth creation in terms of dollars. So, what was the biggest value creator over the past decade? Well, that was SPY, which generated shareholder value of 351.9 billion. So a good run for SPY, which was knocked off its perch by VOO recently. The number three ETF is, in terms of size, is IVV, which is the number two value generator, followed by QQQ. On the value destruction side, that's when we start looking at the smaller firms. ProShares, which is not that small of a fund. I mean, they've got $70 billion in assets, which is actually, even though they're the number 12 issuer, that's like 1/40th of Vanguard or iShares AUM. iShares has 3.5 trillion, and so there's a big gap between the number 12 and the number one. But anyway, the biggest value destroyer was ProShares short QQQ, the SQQQ, which shed $10 billion in shareholder value over the past 10 years. The other value destroyers were another ProShares one, the Ultra VIX short-term futures, UVXY, and Kathy Wood's ARK Innovation, which is ARKK, a high-profile ETF. Everybody hears about it. That one has shed 5.5 billion over the past 10 years. So,
Well, Kathy Woods arc, definitely gets a lot of ink, from people,
yeah.
a lot of attention. But the ProShares, what ProShares is doing, what do you think is contributing to them to having kind of the reverse Midas touch over the
Well,
last?
you'd have to maybe take a close look at each one of these over the past few years. Well, obviously, SQQQ was going in the wrong direction for the past, for 2023, 2024. I mean, we had what, 50 something percent market gains S&P 500 over those 2 years. Now, I haven't checked the flows on SQQQ. Maybe people are piling back into that one. And as Kent always likes to point out, these short funds are really for short-term trading. You don't hold on to them for a long time. So maybe it's a little unfair, but it's kind of a guide. Like if you're a long-term investor, stick with SPY. So
Right. Hey, Ron, I was going to add right there while you're talking, I'm thinking how ironic it is that those inverse ETFs, it's basically shorting stocks or shorting ETFs. So some of the value creation is actually because those short sellers have to cover their positions and buy back the shares. So, I mean,
Excellent
the
point.
the in the short term, you can win with these inverse ETFs, but a lot of those buyers of these ETFs are losing, and by virtue of them having to buy back shares, or the way these things work is that the
Mm,
money goes back into the pocket of the long term. So
yeah.
buy and hold wins in the long run,
Yeah.
but these inverse ETFs do not win in the long run.
Well, I guess in a case like this, it's probably the casino always winning, right? Because of the fees that are on these short funds. I mean, I've never worked in an ETF issuer's office, so I don't know what the books look
Right.
like, but I would assume that they are priced for the
Right.
volatility. And ProShares is looks like, I mean, it is a number 12 ranked issuer. So,
Well, there's a market
I'm
for it.
sure,
There's a market for it. There's going to be
yeah,
perma bears out there. There have been people who've been calling for the market to go down, that it's overvalued for a long time. And if just because an issuer decides to cater to that market and that angle of investing doesn't necessarily mean that they were offering a product that was, deficient in some
right,
way. The point
right.
that Kent was making is a good one. If you're going to go into the market, and Ron, you shared earlier today a graph about market timing is all about what market you're during the time. If you
Yeah,
go in and buy and hold, even if you go in at the top of the market, if you stay the course, you're still going to come out on top
yeah,
over the long
yeah.
term.
Yeah, you're right. I mean, these are people, their expertise, fund issuers, I mean, they're marketers, right? They
Yeah,
want to know what's the
they got a
market looking
product.
for.
Yeah.
Yeah.
Yeah,
So,
absolutely. Speaking of products, nice segue into the next story. Kent, when I heard your pitch for this story, I was so surprised to find out that Vanguard does not have a gold ETF. So,
Right. That is a good segue in more than one way, because talking about just issuing anything that investors or traders may demand. Of course, there's a demand, like you said, for inverse ETFs, because there's people that are betting against the market. But Vanguard, I can't speak for them, but I can tell you what I've observed is they don't issue ETFs just because they can. They've never done that. And a more timely or modern example was their spot Bitcoin ETFs. They didn't issue those when they could have. They probably could have had the largest Bitcoin ETF on the market if they wanted to. But now they did. The history is that they did several years ago have a fund called Vanguard Precious Metals and Mining. That's a mutual fund. VGPMX. It still exists. They just changed the name. Vanguard. It's called Vanguard Global Capital Cycles Fund. So that has about 25% exposure to the equity side, which would be stocks and companies that are miners, gold miners, or precious metals in general, not just gold. But they also have a commodity mutual fund, the Vanguard Commodity Strategy Fund. It's about 20% gold, and they use mainly futures. But yeah, they do not have a gold ETF that's dedicated just to that. And my guess is, again, not speaking for them, but I would say that they're just aiming to provide ETFs and mutual funds that are targeted to their shareholders. They do what they do best, and they don't just issue ETFs just because they can.
with gold at record highs, it's it begs the question, do you think they will consider going for the gold and creating that gold ETF? That's purely speculation on. What do you
Right. I'm not. But my first thought that comes to mind is I'm an old school Vanguard guy, so I'm thinking about Jack Bogle. Jack Bogle wouldn't do that. So I think that they hold to those traditions still at Vanguard, which is one of the things that people love about them. So I kind of hope that they don't issue a gold ETF just because it's at record highs.
That's an interesting point of view. Ron, what do you think? You think they'll go for the gold?
well, they are a traditional outfit, I mean, they've stayed away from the crypto ETFs. So, but and maybe they'll use it to mark maybe they'll launch one to mark their 50th anniversary, which is coming up.
Nice way to mention that we're going to be covering their 50th anniversary of the first mutual fund that's coming up May 1st. Yes, and we're going to
Oh, is that
discuss
intentional
that.
on my part?
Well, oh, I don't know. Are you writing something about that?
That's a good
Well, listeners, you'll just have to wait and find out. Anyway, thanks to all of you for tuning in to Exchange Traded Fridays this week. Remember, if you haven't already, please subscribe and follow us wherever you get your podcasts. And if you have a question or just want to share your thoughts, join the conversation with us on X, formerly Twitter. Our handle there is ETFCOM. Have a great week.